So, you guys all have the ability to offer everything from personal loans, every type of business loan available, any kind of investment real estate funding, aircraft financing, whether your client's funding the full aircraft or just parts alone. You're also able to offer credit card processing to pretty much any type of business. So you guys are able to offer a huge variety of different funding opportunities to your clients. So we'll start off with business loans. So for business loans, you guys can offer, like I said, everything under the sun. So you can offer longer term loans that extend out to several years, or you can even offer the shorter term loans, which typically start out at 2 to 3 months and can be about a year or two in the term. So you guys are able to offer SBA loans. They take a little bit longer to close than typical. The competitive area to that is just a business term loan. You're able to offer franchise funding, equipment loans, merchant cash advances, lines of credit, credit card stacking, which is a type of, in some ways it's kind of like a debt consolidation for businesses. Invoice financing, which is technically also considered factoring. And there's also some other programs in there that are more, or less mainstream, that aren't even listed. But you guys should all know that pretty much any client that comes to you for any type of funding program, you're able to offer. The basic requirements for any type of business loan is they have to be in business at least 6 months. They should be doing at least $10,000 in revenue. Once they're doing over 20,000, it gives them more options and better rates and terms available to them. They have to be putting their revenue through a business bank account. If they're not putting all of that revenue through an account, they do have to be putting, at least the majority of it. You will find sometimes business owners will not report their cash revenue or not put that through their bank account. So if that's the case with any clients that you have, you can't report that cash as, as real revenue, basically. And then, of course, they have to be able to provide all their articles of incorporation, LLC documents, at least 3 months of business bank statements, their photo IDs for all owners. And then, so because you guys are able to offer business loans as well as credit card processing, you also, every time you have anybody come in for a business loan, you always want to ask for their last month's merchant processing statement. This way you can cross-market from a person that owns a business to also try to offer them merchant processing. Separately from the business loans, merchant processing allows you to make residual income. So if you sign up just one client under a merchant processing contract, you're able to make money off of that one client every month for as long as they're going to be a client underneath your services. They also have to be able to provide a voided check or direct deposit form, and that's just so that the lenders know, where they're going to be sending their funding for once they get approved for their business loan. And then for term loans and lines of credit, you're going to be requesting a majority of these same documents as the MCAs, but you're also going to be asking for additional financials. So 2 years of tax returns, operating agreement is required if there's multiple owners of the business. The business overview and history is not a full requirement, but it's good to have just so you have a little background on their business, how long they've been operating, a little bit about the ownership. Loan application history, that tells you if they've already been shopping other loans with other lenders. And then a company debt overview is going to tell you if they have any previous business loans, any other positions, because in order to get them approved for really any type of loan, if they have any outstanding loan balances with another lender, the new lender is going to take that into consideration. Sometimes the older positions will be paid off by the new lender, but sometimes they add another position alongside the previous position. I know I'm going a little bit fast. Any questions on business loans?
Nope.
Okay. So for real estate loans, you're able to offer funding for any type of investment property. So whether it's a single family Airbnb or a multi-family long-term lease property, um, you know you can go up from 1 unit or 2 units up to several hundred units, like a big apartment building, big condo complex, or townhome complex, anything of that nature. You can also offer funding on commercial properties, which would be anything that is occupied by a business. So that could be like a store, a restaurant, a storage facility, you name it. Again, you can offer funding for it. There's also mixed use properties, which is partly residential, which will be occupied by like a family, and then partly commercial, which will be occupied by a business. For these types of properties, you're able to do, fix and flips, ground up constructions on empty lots, hard money loans for people that don't want to provide as many documents and a quicker closing, full-on commercial loans, rehabs or renovations. So if somebody's, has a property they just purchased, they didn't get a fix and flip loan to begin with, but they want to end up selling it or holding it as a, long-term rental property, you can get them the, rehab or renovation loan. Doesn't matter whether it's short or long-term tenants. So, like I said, it could be a short Airbnb rental or something that's more of a long-term lease. Single family, multifamilies, as well as hotels and motels. We can also offer funding for, real estate developers who might be building neighborhoods. Resorts are a little bit tougher, but we have a few files that, they're building condo complexes and marinas, casinos, things of that nature.
I have a quick question.
Okay.
Are the funds only for use in the U.S. or after we lend it, does it,
You're asking if the funds are only available for the U.S.?
or the use for the funds are only available to develop things in the U.S.?
So we have lenders that will do things outside of the U.S. We also have lenders that will do, if they're foreign nationals, like from other countries, purchasing or doing anything here in the United States. Um, as far as the real estate goes, the other countries can be a little bit tougher.
Uh-huh.
But for business loans, you're able to offer funding in the UK, South Africa, Canada, Puerto Rico, and Australia as well. And right now we're trying to break into the Middle Eastern market in areas like Dubai, and a little bit more Eastern Europe, like Italy, Greece, things of that nature.
Gotcha.
So I think for the real estate outside of the U.S., we can definitely do Canada. The UK, I don't think we can do UK on real estate. I would have to check on that. And then we do have some that will do lending in Mexico. But for those ones, so Canada is fine, but for the ones like in Mexico, they have to be using assets or collateral here in the US in order to get their funding for the other country.
Gotcha. Okay.
You have to kind of think of it in a way as, if these lenders are funding a project that's in another country and the lender's in the US, they have to have some kind of recourse to, if there's a default on the property or a default on the loan, they have to have some recourse as far as like asset forfeiture or any type of seizure.
Okay.
All right. Real estate loans are a lot more in depth than the business financing. So you'll see that, there's a whole long list of different documents that are required from the borrowers here. Um, Schedule of real estate owned is a list of all the properties that the borrower owns. Personal financial statement, which you guys will get familiar with. Personal financial statement is just a breakdown of, if there's multiple borrowers on the deal, you need one for each borrower. And it's just a breakdown of all their, income streams, any assets they own, what their credit's like, and what their bills are like. So on a personal financial statement, I'll actually pull one up real quick, and I'll pull up a schedule of real estate owned. Just give me 1 second. Um, on a personal financial statement, that's going to give you a better background on the borrower themselves. So you'll be able to get an idea of, as I was saying, if they own other assets, what their bills are like. Something you guys all will want to get familiar with is what's called a debt to income ratio, or a DTI. A lot of the times in these lending programs, the debt to income ratio comes into play because that tells lenders whether or not these people can actually afford the loans that they're trying to take out. And this is a typical personal financial statement. 1 second here. So, personal financial statement again just gives you additional background on the guarantors or the borrowers of the loan. Up top's basic information, name, address, if they have a business, all that basic information. When you get down towards the bottom, you see assets. So principal and co-principal, you might as well think of those terms as borrower and co-borrower, or if it's a couple, or any type of people that would be filing taxes together, or anything like that, joint. Um, Cash in institutions is basically cash in bank accounts. Government securities are kind of like bonds. Equity interest is for like if they have any joint venture business programs or projects they have going on. Accounts and notes receivables are what I touched on before when I was talking about the business lending. When some of these people have businesses and they have accounts receivables, these are invoices that they send to other businesses and they may not be paid out on for 60 to 90 days. So, accounts receivables is considered an asset because that's something that is basically like cash, but it's more longer term cash. Real estate owned. This goes back to the schedule of real estate that I mentioned previously. You see that'll be on Schedule C, but that's just going to be a list of any properties or assets that they own that's real estate. Automobiles can be considered assets. Life insurance is considered an asset. IRAs, 401ks. Pretty basic stuff as far as assets go. Liabilities you can think of as anything that is a debt for the borrower. So credit card payments and balances, loan payments and balances, auto payments, or auto loans, I should say. Even with business loans and things like that, if they're a personal guarantor on a business loan, that's something that you're going to want to take note of. And this is what all plays into that debt to income ratio I mentioned earlier. So when you do a personal financial statement, you're going to compare all their assets to all their liabilities, and that's part of the way of figuring out your client's debt to income ratio. You see also listed here unpaid taxes, mortgage loans, land contact or contracts. Pretty much any kind of debt that would show up on a credit report is listed here. You're also taking into consideration sources of income, dividends, real estate incomes, and commissions if they have a commission income, anything of that nature. And then pending legal claims like a lawsuit or anything like that, tax liens, and that's pretty much it for the personal financial statement. Let me pull up a schedule of real estate real quick. Any questions so far?
Nope.
No? You good? All right. So this is a typical schedule of real estate owned. You just want basic information about the property, so the address, who's holding the title of the property, what their insurance payment is, what the current value is, their mortgage balance, rental income, and taxes. Now, when you guys get into real estate, what you're going to see or what you're going to start hearing is what's called a DSCR loan, which is considered a debt service coverage ratio loan. And what that is that takes into consideration a property's overall revenue. So if it's a rental property and it's making $1,000 a month, and that same property, the expenses are, let's say, with the mortgage, taxes, insurance, and any HOA fees. Let's say those expenses are $500 a month out of the $1,000 it makes in rental income. That property has a DSCR ratio of 2.0. So that's something you guys will want to get familiar with, DSCR or debt service coverage ratio. And again, all that takes into consideration. Another term you're going to want to get familiar with is PITI, which on a mortgage is the principal balance of the loan, the interest, taxes, and insurance. So it's PITI. And you guys will all be getting a copy of this document I'm reading off of here, so you guys will have something to study as well if you have anything that you want to refer back to on your own time. Just like everything else, you want W-2s or 1099s so you have, their proof of income, tax returns so they've been paying their taxes. It's pretty basic stuff outside of that. When it's for real estate, you're going to want their property tax bill, deed or title. That goes back to that form I was showing you before. You want to know who holds the deed of the property. List of existing business debts. That's if the property is owned by a entity like an LLC or a corporation of any kind. Property insurance. That comes back to the DSCR. You're going to want to know all these expenses. If they're doing a rehab or any kind of fix and flip, you have to have the information about the contractors that you're using, the list of budget, renovations, materials, labor expenses, everything of that nature. If it's an occupied property, you're going to want copies of the lease agreements so that you can have the names of the tenants, what unit of the property they're occupying, and what their rental expenses are, as well as, if they have a second job or a side hustle of any kind, you're going to want proof of that additional income. When it comes to real estate financing, whatever revenue the client's business is generating or whatever income that client's generating shows the lender that they're more capable of covering the mortgage on the property. So you always want to think, what's their income, what's their debts, and then of course, things like credit report come into play, as well as, overall background for the borrower. Another thing that will come into play as well, especially on like rehabs, renovations, and fix and flips, is the borrower's experience. So if they have a lot of experience with similar types of projects, they'll have better rates and terms on the loans than somebody that just started, they're trying to get their first fix and flip going, or it's their first renovation project. If they own the property under any kind of entity like an LLC or corporation, you're going to want all of their business documents like their articles of incorporation, EIN letter. In addition to their personal bank statements, you'll also want their 3 months business bank statements and then tax returns for the business as well. Questions on real estate? Okay. Personal loans are very quick and easy. Once you guys start processing personal loans, the application takes the borrower maybe 5 minutes to fill out. Once they submit that application, we'll find out pretty much immediately whether or not we're able to get them an offer from any lenders. But the requirements for the personal loan, it has to be at least $1,000 loan. Of course, they have to have some form of income, because if we are able to get them funding, we have to make sure that they're going to be able to pay the bank note on the loan. Typically, for these, you want to see at least a credit score of 600. I have seen people get approved with a little bit less, like a 550 in that ballpark. Personal loans, they also take into consideration what the person's getting the loan for. So, like if somebody's trying to take out a loan for just a large purchase and they have a credit score of 600, they're less likely to get approved than somebody that has a 550 credit score, but they're taking out a loan for debt consolidation. For you newer people in here, I know I'm going a little bit fast, but we'll go through a lot more of this, and it's a lot of information at first, but we'll make sure that you guys get the hang of all this. So merchant processing, this is what I was going back to saying before about with the businesses and cross-marketing your clients. Merchant processing is any type of credit card transactions for any type of business. So you guys are all able to offer this merchant processing to any type of business out there. Different industries do provide different risk levels. So like, a tobacco shop is considered more higher risk than, a restaurant or something of that nature, a bar, because these merchant processing companies, they look at these industries through different risk levels. You're able to get merchant processing for any type of business, but a restaurant's easier to get approved for than, a marijuana dispensary or something like that. And then, of course, for credit card processing, they have to have some type of business. It doesn't have to be a brick and mortar. It can even be a home business. And they have to have a need for credit card processing. When we're pitching anybody credit card processing, you can tell your clients all day long, we guarantee to beat your current transaction fees. That's always a good way of incentivizing people to sign up with you. You're also able to offer them what's called a cash discount program. Is anybody here familiar with what the cash discount program is? No? So, has anybody gone to a gas station and saw that they were charging more for paying credit than they were for paying cash?
Yeah.
So that's basically a cash discount program. So what that does is that allows the business or the merchant to offset their cost of transaction fees and put those expenses onto their customers. So instead of them paying 10 cents per transaction, they charge that to their customers, and they're able to save their business, tons of money every month or every year, depending on how many transactions they do. So for required documents for merchant processing, like I mentioned when we were going over the business loans, last month's merchant processing statement. A merchant processing statement is going to explain to you what that merchant is paying in transaction fees, what they're paying differently for Discover transactions versus American Express transactions, what they're paying for the actual point of sale terminal. It'll give you all that information about what the merchant is getting as far as their merchant processing provider. Just like the other loan programs that were business-based, you want their articles of incorporation, EIN letter, business bank statements, photo IDs, and voided checks. Aerospace financing, like the real estate stuff, is very complex. So for aerospace financing, you can go from anywhere from 25,000 up to any amount. If it's a $100 million jumbo jet, you're able to offer that financing, or if it's like a $5 million G4 jet or something along those lines, we're able to finance everything between those amounts. You want to see at least a 600 credit score, but like any of these other loan programs, the better the credit score, the better the rates are going to be, and the better the terms for the borrower. Aerospace financing is the only loan program that requires actual ink-signed contracts. All the other ones can be signed virtually or online. Some lenders will require notarized signatures. Like the other programs, they have to have a photo ID, insurance, logbook entries. The aircraft stuff, like I said, it gets very complex. So the logbook entries is for every year or every flight these aircraft take. There's a logbook that's filled out with every flight or every maintenance period, and it explains where it was flying to, how many passengers it was carrying, both the destination and where they were departing from. It'll also explain all the maintenance logs, so every time the plane got an oil change or changed a tire, anything of that nature. With aircraft financing, the lenders are going to require, photos of the interior and exterior of the plane, the tail number, signed purchase agreements. There's all kinds of stuff that goes into this. Even a pre-purchase inspection signed by the inspecting mechanic. If it's registered into an LLC or corporation, you're going to want their IRS documents showing the LLC, EIN number. So the printout from the Secretary of State is also known as a certificate of good standing for the business. Some of these planes have to be registered with the International Registry, which is just how it sounds. Planes are registered with the International Registry all around the world, so that obviously, since it's an international type of business, you could sell a plane here in the U.S. to somebody in Brazil, and these planes are all registered on the registry. Questions or anything? Again, I will be sending you guys a copy of this. This way you can kind of go over it in your own time.
Apply now, don't wait. With ETG, we'll set you straight. Financial freedom's just a step away. Take the leap and you'll be on your way. No more stress, no more doubt. With ETG, we'll help you out. Don't hesitate, don't delay. Apply now and pave your way. apply now. Don't wait. With ETG, we'll set you straight. Financial freedom's just a step away.